On Thursday, July 23, Wall Street had its roughest day in months. The Dow Jones Industrial Average dropped 506 points, nearly 1%. The S&P 500 fell 1.2%. The Nasdaq Composite, loaded with technology stocks, dropped 2.2%. Financial media reached for two explanations at once. Oil prices had surged after Yemen's Houthi militants claimed attacks on Saudi Arabian tankers in the Red Sea, pushing Brent crude past $100 a barrel. At the same time, Alphabet and Tesla both reported earnings that spooked investors. Alphabet raised its 2026 capital spending forecast to as much as $205 billion. And both companies posted negative free cash flow for the quarter. Two very different stories, blamed for the same bad day. Only one of them turned out to matter the next morning. Let us sort the signal from the noise. Start with the oil story. Because it moved fast and hit headlines hardest, Houthi forces claimed responsibility for attacks on two Saudi Arabian oil tankers passing through the Red Sea, a route that carries a significant share of global seaborne oil traffic. Markets read that as a signal the wider Middle East conflict could escalate and threaten oil supply more broadly. And Brent crude, the international pricing benchmark, jumped past $100 a barrel on the news. Oil price spikes ripple through markets in a fairly predictable way. Higher fuel and input costs squeeze corporate margins, raise inflation expectations, and complicate central bank plans to cut interest rates, all of which make investors nervous at once. Geopolitical oil shocks like this one are common. And history shows most of them are short-lived unless the underlying conflict actually escalates further, which is exactly the open question markets were pricing in that Thursday. The second story ran deeper and had nothing to do with oil. Alphabet beat earnings expectations on paper, but investors focused instead on its raised 2026 capital expenditure forecast, up to $205 billion, mostly for AI data centers and computing infrastructure. Tesla's results landed worse. Its stock fell 14% on the day. Both companies reported negative free cash flow for the quarter, meaning they spent more cash than they brought in, largely funding the current wave of AI infrastructure build-out. That is the sharper end of a debate that has been building across the technology sector for over a year, whether the enormous sums being poured into AI data centers and chips will generate matching revenue within a reasonable time frame, or whether spending has outrun demand. Alphabet stock fell 7% that day, specifically on the capital spending number, not the earnings themselves. A distinction that matters. This is where the two stories split apart. And the split is the actual finding here. By Friday, July 24, oil prices had retreated as fears of immediate escalation eased. And the Dow rebounded, gaining 235 points, up nearly 0.5%. The S&P 500 closed essentially flat, but the Nasdaq kept falling, down another 0.6%, even as the broader market recovered. That divergence is the tell. Once the geopolitical shock faded, most of the market moved on. Exactly what you would expect from a shock that markets decide was overblown. Tech stocks, specifically the ones most exposed to AI capital spending, did not bounce back the same way. Because the question hanging over them was never about oil in the first place. It was about whether hundreds of billions of dollars in AI spending will actually pay off. And one calm trading day does not answer that. Reading 1 or 2 trading days as a clean verdict on anything is a mistake markets punish constantly. Price action this short is genuinely noisy, driven as much by algorithmic trading, options expiration, and short-term positioning as by any coherent narrative. And the same Nasdaq weakness could just as easily reverse at the next round of earnings if AI revenue numbers come in strong. Nobody, including professional traders, can cleanly separate rational repricing from short-term sentiment swings while they are actually happening. That clarity mostly arrives in hindsight. Weeks or months later, the AI capital spending debate itself is genuinely unresolved among serious analysts. Some argue this is exactly what necessary infrastructure investment looks like before payoff. Others see a spending race outrunning demand. Treat any single week of stock moves, this one included, as a data point in a much longer argument, not a final answer, and never as personal investment advice. Quick recap. Thursday's sell-off. Dow down 1%, Nasdaq down 2.2%. Got blamed on both a Middle East oil shock and rising fears over AI capital spending after Alphabet and Tesla earnings. Friday's session split those two stories apart. Oil retreated and the Dow recovered, while the Nasdaq kept falling on AI spending concerns alone. So, signal or noise? Split verdict. The oil shock was mostly noise. A real event that markets priced in fast and mostly unwound within a day once escalation fears eased. The AI capital spending worry looks more like signal. It persisted past the initial panic and reflects a genuine, ongoing disagreement about whether AI infrastructure spending is outrunning near-term returns. The honest takeaway: watch what does not bounce back. That is usually where the real story is. Subscribe for Markets Explained without the panic or the hype. Signal from the noise. Every week,